Hey everybody, it's Daniel here from Infras. Hope you're all doing well. So last week we got the jobs number from both the US and Canada. Now the US numbers came in better than expected at 139,000 versus the expectation of 126,000. And the Canadian employment chain came at positive 8.8 thousand versus the expectation of a negative number of 11.9K. So that was kind of a relief. However, when we look at other components, let's first look at the US number. The average hourly earnings came at 3.9%, a little bit higher than the expectation, hinting towards higher wages on a year over year basis. And when we look at the unemployment rate, it's steady at 4.2%. So overall, it looks like according to these numbers, things are just plugging along, and the U.S. markets economy is doing fine, especially with the unemployment rate still sitting at 4.2%. Right? If I pull up a chart of the U.S. unemployment numbers and look at it, for quite some time, it's really just been range bound from 2022 till now, just sitting in the range of 4.3% and the lowest being around 3.5%. Now it's really sitting not at the 3.5 bound. Now lately the bound tends to be around 4% and 4.3, but not much change, just really sideways here. So when you look at that from that perspective, it looks like the U.S. market and economy is resilient and strong. From that perspective, we also got the U.S. inflation numbers today coming in lower than expected, causing bonds and stocks to go up. And now you have the expectation of traders seeing 2 rate cuts finally happening this year. Before it was 0 rate cuts, right? With fears of tariffs and inflation spiking up. But that doesn't seem to be the case, and it seems like, with the current CPI numbers that we got, it came in lower than expected, and that kind of is giving tailwinds for the equity in the bond markets. And the expectation is that we could see lower rates, lower yields if that's the case. We also heard Trump today discuss about a deal with China, which is also giving some legs to the equity markets. Now, initially we saw a spike and then it came back down. So kind of a muted response, but we're seeing more of this push up higher in U.S. equities based on all this positive news. So we could see continuation of the U.S. equity markets melt up higher and higher as good news, continue to come out, whether you believe it or not, right? At the end of the day, you gotta watch what's the price action telling you, right? Where does it want to go, and what is the equity markets telling you? Because at the end of the day, if information tends to be speculative, because if you expect certain information to move the markets, and you believe that's the theory, that the price should be higher due to this information, and it does move to that price based on that information, then that's a good sign. But if it doesn't, right, and it tells you it's already baked into the markets, or there's an expectation that maybe it's not so much of an amazing news, or there's uncertainty or fear still around certain subjects, whether it's tariffs, whether it's rate cuts, whether it's recession, or etc., etc. But what I can definitely tell you is that we are seeing a grind up higher, slow grind up higher in the equity markets, U.S. equity markets, as U.S. stocks move up higher. And they're doing it more cautiously, it seems. Now let's go back. Let's just start. Not now that we know about a little bit of what's going on in the U.S. Let's talk about Canada. Now Canada is a different scenario here, right? So we got the employment change a little bit higher, plus 8.8 thousand versus the expected 11 0.9 thousand, right? That was the expectation, that we get a negative number. And we got the full-time employment change at 57,000, part-time employment change negative 48,000. But the big thing that I like to look at here is the unemployment rate, now at 7%. Okay, so we have the unemployment rate sitting at 7% in Canada. And this has been grinding up higher. If you've been following this channel for some time, grinding up higher and higher. And I've been saying that expect, especially the property market, to not do well even when you get those rate cuts, because you are getting growth and the job market deteriorating here. And we keep hearing it, and I'm going to say it again, and we keep hearing it. Every single time we hear from people outside, professionals outside, saying that the real estate market is going to do well, things are going to pick up rapidly, and you better get in before it's too late. Don't get me wrong. We'll be higher. We'll definitely be higher in prices in real estate 10, 15, 20 years down the road. For sure. It will be more unaffordable. 100%. We are headed towards an environment where things will get more expensive, more unaffordable, and it's going to get worse. 100%. But let's not kid ourselves and create FOMO in the markets and mislead people, telling them you better get in now before it's too late. Now, you purchasing a property, you purchasing a stock is dependent on your circumstance. I don't know your circumstance, right? Everyone's circumstance is different. My circumstance, your friends, your brothers, your brother-in-law, your mother-in-law, whoever it is, right? Everyone's got a different financial look, different, situation in terms of their career, in terms of future expenses, whatever the case may be. I don't know, right? But let's not kid ourselves in the fact that the unemployment rate, right, was at the 4.9% bound in 2022, and we're now sitting at 7%. Okay? Let's not kid ourselves here that we are at 7%, which is basically half of COVID's peak. Let's not kid ourselves that every time that we start to creep up in the unemployment rate, right, we get to 7% and 8%. We saw this back in 2007, 2008, and back in the dot-com bubble and burst and so forth, that there tends to be trouble down the road. So what does this tell us, right? The unemployment rate is peaking up while in Canada, while the US is fine. Eventually, I do see that US will follow the same trajectory. It's just a matter of time. But there's lots you could argue about, why it's been stagnant for some time, money printing and pumping and whatnot. But focusing here on Canada, a little bit more under trouble, especially when you have this unemployment rate creeping up. And you hear about you heard recently Doug Ford, right, come out and discuss that crying for rate cuts to come soon so that the condo market could be saved, so that the housing market could be saved, right? Because Dougie needs to make his builder friends happy, so he wants those rate cuts for sure, right? But anyways, politics aside, the data is definitely showing that you are getting that creep up, a quite significant creep up over the past couple months and years in the unemployment rate. That doesn't suggest good things at all. Now, let's read up a little bit about this labor report that came out Friday for Canada. So when we look at the unemployment rate by age group, we see 15 to 24 years old, it's sitting around 14.2%. So the youth unemployment rate is quite high. Okay. And it's been in range bound in around the 14%. Wouldn't be surprised if we break the 14% and move up higher. The core age with 25-year-old to 54-year-old is sitting around 6% in Canada. And the 55-year-old is sitting at 5.3%, so a little bit below the average, right? But the core age of 25 to 54 is sitting at 6%, well above the average of 5%, and it continues to move up in this linear graph pointed towards to the right. So we're seeing that happen in all the age groups, but the 55-year-old, kind of holding up a little bit stronger and better here. When we look at the unemployment rate for returning students, it's the summer months now. Returning students who are age 15 to 24 looking for those summer jobs. What do we see here? Now, for the returning students, we're seeing unemployment rate of 20%, 20.1%. The last time we saw 20% was in 2009, right? After the great financial crisis. We also saw that before the dot-com bubble bursting in 1999 of 20.1%. We see that today again. When we look at the employment change in industries, so the industries that are doing well versus the ones that are not, right? The ones that are adding jobs are wholesale and retail trade. Information, culture, and recreational is also adding jobs. Finance, insurance, real estate, rental, and leasing adding jobs. Healthcare and social assistance adding jobs. Professional, scientific, and technical services adding jobs. Educational services adding jobs. Utilities adding jobs. Natural resources adding jobs. The ones that are losing jobs are the public administration, the accommodation and food services, the transportation and warehousing, business, building and support services, manufacturing, construction, agriculture, right? So you're seeing a lot of these jobs, job losses happening there as things tighten up, especially in construction. You're seeing the negative there, the manufacturing, the negative there as well. So some pain in those sectors. Now, when we break it down, the national average of unemployment rate in Canada is 7%. When we break it down to the different provinces, we see Ontario sitting at 7.9%, right? A strong province for Canada, about almost 8%. British Columbia, 6.4%. Alberta, 7.4%, right? Nunavut, 9%. Newfoundland, 9.7%. PEI, 8.2%. Quebec, 5.8%. Saskatchewan, the best one out of all of them, Yukon Territory is 3.6%. It's the best one. Then you got Saskatchewan, 4.2%. Manitoba, 5.9%. But your main sectors, Ontario, Alberta, British Columbia, all above the 6% level, with British Columbia 6.4, Alberta 7.4, Ontario 7.9%. And when we look at these cities in Ontario, the highest one being Windsor, 10.8% unemployment rate. Oshawa, 9.1% unemployment rate. Toronto, 8.8% unemployment rate. Barrie, 8.4% unemployment rate. We move into other cities such as Calgary, 7.8%. Edmonton, 7.3%. Kitchener, Cambridge, Waterloo, 7.3%. Niagara, 7.1%. Montreal, 6.9%. London, 6.9%. Hamilton, 6.7%. Vancouver, 6.4%, right? So the main cities, Toronto being 8.8%, almost to the 9% level. The unemployment rate is peaking up. People are having tough time finding jobs. People are not hiring and are freezing in terms of when it comes to hiring as well. So this is not going to be a good thing, because as these consumers and these individuals stop getting, stop working, or they're not getting their pay, they're going to spend less, which means that businesses are going to feel the pain, and then you're going to get more layoffs, and then you're going to see that unemployment rate get worse and worse, the jobs number get worse and worse, growth and production, GDP getting worse and worse. We're already seeing that, especially with immigrants not getting the jobs that they want, immigrants leaving, right? Influx of immigrants, low housing supply, um, costs of goods are higher, and so forth. So things are not looking good for Canada in this situation here. So what can we expect from this as this progresses and as this gets worse off? Guess what? You're going to get the rate cuts back again. Always happens. You get rate cuts, you get pause, and then oh shit's hitting the fan. Let's go to, escalating those rate cuts further, and then you're going to get those emergency rate cuts. And guess what's going to happen? You're going to get those same people out there. Oh, rate cuts are here. Go and buy. Buy. We're going to see a big boom now. It's big boom now. Well, no. We're coming off of a peak in 2022. Okay, the market's peaked. The real estate market peaked in 2022. The cycle always works in this way. Okay, there's a chance. Okay, I could be wrong. Sure. I shouldn't say it always works. High probability, high odds when you look at historical data, when you look at past economic history. Okay, because nothing's perfect, nothing's 100%, and I can be wrong for sure. But historically, I should say, we tend to see the cycle, where it peaks, then it comes back down, and then you get those rate cuts, and then a pause, and then you got rate cuts back again, then emergency rate cuts, money printer, you get the trough, and then we're back. So we're close, I wouldn't say, maybe not too close, but we're close to getting to the trough, and then you're going to get money printer going burr. You're going to get inflation probably maybe ticking up again. Probably we will maybe see some disinflation, deflation, depending how severe the recession is. So asterisk, depending on how severe the recession is. And then that will also, we'll see the reaction from Bank of Canada and the money printer. And yeah, if you are in a good financial standing and you can take advantage of lower prices and assets, then great. It's a great opportunity for you. Lower rates, buyer's market, you can get in and then take advantage for the long run, right? But let's not kid ourselves of what is looking like what is coming down the pipeline. The trend continues to be going up. I've been saying this for 2-3 years. We're seeing that trend. The markets can do whatever it wants. It can be irrational longer than you and I can remain solvent. The Toronto Stock Exchange can continue rampaging higher. Can get the US stock market melting up. Gold can go up. Crypto can go up. Whatever your trading strategy is, let it be, right? But in terms of the data and the economics, don't be surprised if you get a oh shit moment where we hit a wall, a brick wall, and things rapidly tumble and reverse the other side. So all I'm saying really is, yes, the consensus tends to be over the long run, equities move up higher, real estate goes up higher, because inflation and because of money printing and how the system works and whatnot. Asset inflation will always continue to rise, but don't be crazy and don't be stupid, right? Also have enough buffer and cash and play out all the scenarios, right? Scenarios of, if XYZ happens, what will I do? Will I have some cash reserves in order to weather some sort of storm? Will I be able to handle such and such fluctuation in my portfolio and whatnot? These are all questions that you can ask yourself and see, kind of stress test and put yourself in those kind of positions and scenario and think about them and see if it makes sense for you. But until then, I'll continue to bark on this channel and continue to tell you what's going on in the economics and the data. And if you like what you hear, subscribe, hit the like button, share this video, leave a comment below on what you think and what you're seeing. And I'll see you guys around. Cheers. Bye.